Hey guys, Akil Stokes here. Welcome back to the Trading Coach Podcast. Today, we're going to talk about going live, meaning live trading for the first time, and things that you should know when it comes to like money management strategies or just asset allocation. Now, before we hop into things, I want to remind you guys, or not remind you guys, inform you guys, I guess, that this is another video episode of the Trading Coach Podcast where I do fun things in the background. You can see my beautiful face, of course. So make sure you're on an app that allows you to watch it. I know Spotify does, obviously YouTube does as well. Been trying to do more of these because the numbers tell me that sex sells, and well, I've got massive sex appeal if you didn't know. So let's hop into things, right? Today's conversation, or I guess conversation, because I'm conversing with you guys, comes from another conversation. I have a lot of conversations from our platform with one of the traders that I'm working with. Now, shameless plug, real quick, 10 seconds max. If you're interested in learning how to trade, if you're interested in taking courses, having mentorship, working with a community of traders, head over to our program, www.tier1trading.com. Try the trial membership first. That way you can get on the platform, play around with things, take some courses, hop in some live sessions, and make sure that we're the right fit before making any type of commitment. It's risk-free, so there's no like sleazy auto bill or anything like that. We just want to make sure that we are the right fit for you. If we are, then you can come aboard. If we're not, you can find someplace else that is. And the conversation that I was having on the platform was with a trader who was about to go live, right? Done all the work, been through the courses, and is at that point. It's a magical point, very, very scary as well, where you're finally kind of crossing the I's, dotting the T's, and getting everything in order to actually trade live. And he had the question that says this, I'll read it for you. He says, "Hey, Akil, I'm going live in a couple weeks. I wanted your opinion on starting capital and adding to it. I thought of starting with 5% of my capital and then doubling it every time I hit 10% in profit. Does that sound conservative enough?" And I'll kind of take you back to my philosophy on the amount of capital that you should be allowed to trade when you first get started. Now, obviously, it's your money. You can do whatever the hell you want with your money. That is kind of one of my philosophies in my life. I don't care how people spend their money as long as they're not doing it to hurt people or steal things, I guess. I guess you wouldn't spend money to steal things, but I guess you can if you're investing in things that make the stealing easier. But then that was... Anyway, I'm off topic here. My opinion is that you should treat yourself, right? Add that to the blooper wheel, like in the last blooper wheel. Oh gosh, this is embarrassing. This is why words. It's been a common theme lately. Add that to the blooper reel, like in the last YouTube video I did. But my opinion, my philosophy is that you should treat yourself, right, like a prop firm, right? So the prop firm model is this. I'm not necessarily talking about the online prop firm model, although many of them follow the same suit. But when you're on a prop firm, when you make it to the big time, you get a seat at the trading desk, you're given a little bit of capital to spend, right? Now, as you prove yourself and as your results show that you know what the heck you're doing, you're not a danger to your firm, you get awarded more and more and more and more. I believe that you should do the same thing when you start trading, right? Instead of like taking your full 100% asset allocation and putting it all in your live account and trading it right away, start with a small amount, right? This trader said start with 5%. Then after you prove yourself, go to 10%, 20%, like whatever it may be, however you want to break it down. And we do this because, well, think about it like this, right? It's just like anything in life, any new skill or any new sport, right? When you are brand new to something, are you more likely or less likely to make mistakes, right? You are more likely to make mistakes. In trading specifically, mistakes will cost you money. So you're putting at the beginning of your trading career, you are more likely to lose money because, again, you're making more mistakes and you're just not as sharp and seasoned in the market as you will be 5 years from now. So if that's the case, and we know that to be the case, we want to protect ourselves, right? We should want to start with less because in that period where I'm more likely to do dumb stuff, if I do make a mistake, it'll have a less of an impact, right? Just like the sports betting podcast that we did where we spoke about how, the trader needs to bet, right? And although the best solution is don't do it, follow your rules, process over outcome, if you can avoid giving into that temptation, at least do it with an amount that's not going to hurt you, right? Place that intuition, feeling based bet, whatever you want to call it, with a small amount of capital, so that if you lose, it doesn't really damage your account. Same thing with this type of process. When you're new and making a mistake, do it with a little bit. That way those mistakes don't hurt and they don't completely take you out of the game. Because for many people, right, I don't want to say they work a lifetime, but what they're investing in the market is a substantial amount of income. For a lot of people, it's not just fun money. It's money that they were going to invest somewhere else and they decided to bet on themselves. And if they lose that money, there's no going back. There's no round two, right? That is it. The trading is gone from them. You've blown your opportunity. And it's not fair because you're not really giving yourself a chance to be bad and turn yourself into being good. So that's why I personally like that approach. So I'm 100% on board with that. I personally like to do it I do it in quarters. I do it time-based, and this is what I told this trader, and I guess we'll dig into that part a little bit later. Or I guess right now, we're gonna do it right now, right? So the next part of this question was, right, I thought about starting with 5% of my capital. That's fine, small percent, good. Then doubling it every time I hit 10% in profit. And this is where I had the problem, right? So doubling it every time you hit 10% profit is an issue, right? The thought behind it is good, right? You double it as you prove that you are profitable, right? As you prove that I can make money in the market, I give myself the ability to trade more money. As I make more money in the market, I give myself the ability to trade more money, right? It's good in theory. The problem is this. It's very similar to the flaws that come with fixed fractional money management. Now, if you guys aren't familiar with that, real quick, there's a great book. I haven't read this book, but I was told it was a great book, so maybe I shouldn't. There's a great book I was told called, what is it called? I think it's called The Trading Game, Trading with Proper Money Management, something like that. I apologize, I don't remember the details. Let me just look it up real quick and I can edit this out. Haha, the power of editing. The Trading Game. Playing by the numbers to make millions. By more editing by Ryan Jones. Like I knew it all along. Again, I haven't personally read this book, but when I was taught about money management strategies, I believe this is the book that one of my trading mentors read to start developing kind of the money management approach that we use now. We teach smooth ratio money management, which is smooth ratio comes from fixed ratio, which comes from fixed fractional, and fixed fractional is the issue. So the theory of fixed fractional money management is this. You start with a certain amount. Every time you reach a certain amount, you up your position size by another certain amount. Again, that certain amount is up to you. So kind of like what the trader is saying. I start with 5%. Once I hit 10% ROI, then I trade this much. And then once I hit this, then I trade that much, and it goes up and up and up and up and up. The problem is when you do this, and specifically with like position sizing, so imagine going from 1 mini lot to 2 mini lots to 3 mini lots to 4 mini lots. The problem is that one, if that number is too big, right, a typical number would be like 50%, right? If that number is too big, it's going to take a very long time to actually make that 50% return. So you're trading a very long time before you give yourself the ability to trade a bigger position size. And then bigger picture, once you get going and going and going, now you're upping because your position size is getting larger, right? I know it's not the same as the capital allocation, but just to kind of give you a bigger idea of this money management. Once your position size gets large enough, you're jumping and increasing at such an enormous rate that you put yourself in massive danger. And here's what the danger is. So we spoke about this in another episode of the Trading Coach podcast where I talked about knowing your numbers, right? And how so I'm on a massive hot streak right now at the time of this recording. I've had 2 weeks. They have been phenomenal. I'm hitting at like 85%. It's perfect timing because it's the end of the year. I just got the kids' Christmas list. They have some expensive things on there. So guess where this money is going, right? In fact, I'm going to sign the present from Bat Pattern, from Cypher on December 13th, right? But seriously, I've been on a hot streak, right? So there's two things that I can do with this hot streak. I can get cocky and overconfident and tell you I'm the best trader in the world, do a little pat myself on the back type action, or I could be very, very, very afraid. And I am the latter. Now, I'm not actually very, very, very afraid, but I'm realistic. I know that I'm not an 85% trader. I know that when I have hot streaks, what comes next? Well, cold streaks, kind of to revert me from the mean to the mean. I'm really good with money management, so those cold streaks don't suck up all my profit like they did, 16, 17 years ago. But still, we know that it's coming. Now, the problem with implementing a money management strategy that's so aggressive, right? Because I've made about 10% in the last 2 weeks easily. I haven't done the math, but just knowing my numbers, I certainly have. The problem with that is, right? So let's say I'm trading, what I said before, one mini lot, right? And all of a sudden, I've hit this hot streak, and now I'm upping my position size to 2 mini lots. I'm doing that right as the hot streak is over, right? Because the hot streak is what allowed me to get to the percentage needed to up my position size. Now, what did I just say? I know that this hot streak won't last forever. It's probably at its end, and what goes up must come down. So I'm increasing my position size as I'm more likely to take on a cold streak. So what's the problem with that? Well, I just told you before as well that I'm good at keeping my head above water. So I have these hot streaks, and then I manage my cold streaks so that, yes, I give some back to the market, but not enough to be impactful, right? A normal price to pay for being a trader. But if that position size was doubled, instead of giving back a little bit, because I'm trading twice the size, I may be giving back all of my gains or even more. And this was a consistent kind of cycle that I was stuck in very early on in my trading career. I would have hot streaks. I'd increase at the end of my hot streaks to make more money from it. And then I'd increase right into a cold streak. It really wouldn't be a bad cold streak, but because I was trading more, I would lose it. So that's the issue that I have when seeing 10% profit. You put yourself at risk of increasing your position size, increasing how much you're trading in the market at a time that is more likely to be detrimental to you. Now, again, it's not exactly the same because we're not talking about position sizing specifically. We're talking about account allocation, but the bigger your account is, the bigger your position size is, right? It's all related. So what's the solution to this? Well, what I told a trader was this. I like working in time-based segments. Me personally, I like working in quarters, right? I'm a sports guy. Most of the sports I played were all divided into quarters. So I do 3-month analysis on all of my trading, right? You've heard me say it before when it comes to analyzing the market, when it comes to making mistakes, when it comes to changing things in my trading plan. I only look at 3 months periods at a time because I don't trust anything other than 3-month periods. I can easily be hot for a month and won't make any type of difference in my bigger picture. I can easily be cold for a month and won't make any type of difference in my bigger picture. Typically within a 3-month sample size, I can kind of see the real me. If I, for lack of a better term, it sounds like a documentary, like a 30 for 30, the real me, the man inside the man. After I had a secret double life where I was trading fundamentals. Oh, right. The worst possible thing in the world. Just kidding, fundamental traders. Right? But seriously, so I think the trader should do a combination of both, right? Yes, they should have the return on investment percentage as a goal, right? You want to know that you're making money, but that should also go hand in hand with a time-based goal. So instead of just saying every time I make 10%, it should be more so like if I have 10% at the end of this 3-month period, then I'm allowed to reward myself, because that does two things. One, that shows that you're profitable, but two, it also shows that you're consistent, because anyone can get hot for 2 weeks, right? And having your goal set up with a time-based kind of appreciation period, it just helps protect you a little bit more. That way you can see more of the big picture and really be safer than you would otherwise. So that's my advice. If you have any other advice or any questions, leave them in the comment section below. Hope you guys enjoyed the episode. I will see you guys next time. Until then, plan your trade your plan. Take care.